Welcome to the Deep Dive and our Talk Ticker segment, where we go beyond the headlines of the latest earnings calls. Today, we're tackling the Q3 fiscal year 2025 call from Lee Enterprises. They're a local media company, deep in this massive shift from print to digital. And this one's crucial because, look, the market hammered the stock immediately after the call. But management, they painted a picture of, successful transformation. So our mission is to figure out what's really going on.
Right, and that market reaction was pretty swift. We saw about an 8% drop in the stock price on August 7th, the day of the call. And, if you just look at the headline numbers, you can see why.
Yeah, give us the breakdown. How bad was the miss compared to what analysts were expecting?
Okay, so starting with the bottom line, JAP EPS, that's earnings per share, it came in at negative $0.31. The consensus was looking for negative $0.13.
Ouch, that's a pretty big miss. $0.80 off.
It is. Definitely suggests maybe things were tougher than anticipated. And then you look at revenue.
Let me guess, missed there too.
Yep. Revenue landed at $141.3 million. The street wanted $147.5 million. So, total revenue down 6% year over year. Even if you adjust for comps, same store basis, still down 5%.
Okay, so miss on earnings, miss on revenue.
Yeah.
No wonder the stock took a hit.
Exactly. That's the knee-jerk reaction you would expect.
But, and this is the fascinating part, right? Despite revenue falling short, they somehow kept their profitability in check. Adjusted EBITDA, what was that number?
Around $15 million. And get this, that was actually up about 1% compared to last year.
Wait, revenue down 6%, but core profit up slightly? How does that work?
That right there is the story. It points to some really aggressive cost management. It completely changes the narrative from just, a simple miss.
Okay, let's unpack that. The real story seems to be inside the numbers, in the mix.
Precisely. Management really wanted to highlight this 55% milestone. Digital revenue hit $78 million.
So over half their revenue is now digital.
For the first time, 55%. And that digital piece, on a same-store basis, it grew 4% year over year. I mean, for a company historically tied to print, that's a huge symbolic step.
It's symbolic, sure, but is 4% growth really enough to, make up for the print side fading away? That's got to be the question lurking, right?
It absolutely is. And the quality growth within digital, the part they really leaned on was subscriptions. Digital-only subscription revenue, up a very strong 16% year over year.
16%, okay, that's more like it. Was that just signing up more people?
Not primarily, no. Which is interesting. It was mostly driven by a huge jump in ARPU, average revenue per user, up 28%.
Wow, 28%. So they're getting more money from each subscriber. That suggests people value the content, they have pricing power.
Exactly. It's a good sign for the product itself, but there's always a but, right?
Uh-oh, what's the catch?
The total number of digital-only subscribers actually went down sequentially, ended the quarter at 670,000.
Okay, wait. Revenue per user is way up, but the actual number of users dipped. How'd they explain that?
They pointed directly to the cyber attack back in February, said there were residual impacts still messing with subscriber signups. They basically cautioned that subscriber growth might be a bit lumpy for a while.
And I bet the market hears lumpy and thinks problematic. That execution risk you mentioned. Maybe that cyber incident isn't quite in the rearview mirror like management hopes.
That seems to be the market's interpretation, yeah. They're not quite getting the benefit of the doubt there. But remember, digital isn't just subs. They're agency. Amplified Digital, that had another really solid quarter.
Right, Amplified. How did they do?
Revenue up 10% year over year, pulled in $29 million. That's their engine for local digital ads, high budget stuff.
Okay, so Amplified is growing nicely. And didn't they just launch some new AI tools through Amplified? That seemed like a big focus on the call.
Huge focus. They rolled out this AI-powered suite, specifically named things like Smart Answer, Smart Team, and Smart Suite HQ.
Smart Answer, Smart Team. What do these actually do? How are they supposed to help?
So think automation for local advertisers. Smart Answer, for example, uses their own local data to automatically generate ad ideas, copy, placement suggestions for small businesses.
So cutting down the time and cost it takes to sell and create ads for smaller clients, which is usually pretty labor intensive.
Exactly. Cuts down lead times, makes serving those smaller businesses much more efficient. And presumably, Smart Team helps their internal sales. Smart Suite HQ is a dashboard for the clients.
And they flag their partnership with AWS, Amazon Web Services, too.
Right, as their preferred cloud provider. Yeah. The whole narrative is shifting towards, look, we're not just news, we're becoming a sort of local marketing tech company powered by AI.
It's a software story built on an old media frame. They're betting this AI suite is what kicks that 4% digital growth into higher gear to hit those long-term goals.
That's the bet. That's the catalyst story.
Okay, let's switch gears slightly. Back to how they kept EBITDA flat despite the revenue drop. You mentioned cost control.
Yeah, and it was significant. Cash costs were down 7% year over year. That's actually faster than the first half of the year.
7%. Where did that come from?
It ties back to those $40 million in annualized cost cuts they announced back in Q2, mostly hitting, the non-core print side of the business, taking out overhead there.
40 million annualized. That's a big number. Does that all hit the bottom line now, or?
Not all immediately. They guided that about half of those savings, so roughly $20 million, should flow through and really benefit the results next fiscal year, FY26.
Okay, so there's baked-in margin improvement coming next year, almost regardless of revenue, just from these cuts finally flowing through.
That's the idea. They've surgically removed a lot of cost.
And while they're cutting costs, they have this unique safety net on the debt side, right? That famous Berkshire Hathaway deal.
Yes, the Berkshire Agreement. It's absolutely critical. It gives them incredibly favorable terms. We're talking a 20-year term.
20 years.
A fixed interest rate. And the really crucial part, no financial performance covenants.
Explain that. Why is no covenants such a big deal here?
Because it means Berkshire can't pull the plug or force a renegotiation just because Lee misses some quarterly targets or even those bigger goals like the FY26 sustainability point. For a company with this much debt in this kind of transition, it removes a massive amount of immediate financial risk. Bankruptcy risk, liquidity crisis risk. It's largely off the table for the medium term because of that deal structure.
The debt doesn't dictate operations day to day.
Not in the way it does for many other leveraged companies, no. And we saw how valuable that was during the cyber incident. Berkshire actually agreed to pause interest and rent payments for March, April, May.
They just added it to the principal.
Yep. Which gave Lee critical breathing room right when they were spending about $2 million to clean up the ransomware mess. A huge help for liquidity right then.
And are they paying down debt otherwise?
They're focused on it, sold off about $9 million in non-core assets so far this year, and they've flagged another $20 million worth they plan to sell. So, yes, chipping away at it.
Okay, so let's circle back. We have 55% digital mix hit, strong ARPU growth, major cost cuts with more savings coming, this new AI suite positioned as the next growth driver, and it's all backstopped by this very friendly Berkshire debt deal. And yet, the stock drops 8%. The market focused on the headline miss and the subscriber dip. Is the market just wrong here? Or too focused on the short term?
Well, it's that divergence again, isn't it? Liquidity isn't the immediate fear because of Berkshire, but execution risk is front and center. The market sees the misses, sees the subscriber wobble, and worries the cyber impact isn't gone. They see the stock is still way down from its highs, below $20. They're essentially betting against management hitting these ambitious targets smoothly.
Especially that big $450 million digital revenue target by 2028. I mean, that relies heavily on this AI stuff actually working and scaling fast, right? Isn't that a bit speculative?
It's definitely aggressive, but management tried to anchor it by reiterating two key goals. Yes, the $450 million by 2028 is the big prize, but the more immediate structural goal is hitting what they call digital sustainability by fiscal year 2026.
And they defined that, didn't they?
They did. It's the point where their digital gross margin covers all the corporate overhead, the selling, general, and administrative costs. Hitting that point in FY26 would be huge. It would fundamentally de-risk the story, proving the digital engine can actually carry the whole company.
Right. But for now, the outlook seems cautious.
For the rest of this fiscal year, yes. They're guiding for low single-digit growth in both total digital revenue and adjusted EBITDA. So not exactly setting the world on fire in the next 6 months. The market wants proof now. Management is basically saying, trust the process. The AI acceleration is coming.
Okay. Complicated picture. Let's pivot to our next segment and think about how someone might actually trade this setup.
Okay.
All right, welcome to our This Is Not Financial Advices segment. Time to put on our hypothetical hedge fund hats.
And the usual, very important disclaimer, this is purely for discussion and entertainment, definitely not financial advice. Please do your own research. We're just playing out some logic here.
So the thesis we're kicking around today, we're calling it the Berkshire Backstop AI Accelerator Trade. The idea is simple.
Yep.
The stock gets beaten down because it's a small cap, it's volatile, people react to headlines like that 8% drop. Short-term fear.
But underpinning it all is that 20-year Berkshire debt deal. That removes the immediate existential threat, the covenant risk, the liquidity crunch fear. It provides a floor, a pretty solid one.
So the opportunity is created by that short-term fear clashing with the long-term stability provided by Berkshire.
Exactly. And the trigger for the trade realizing value relies on two things we just discussed. First, the AI Suite Smart Answer, Team HQ, actually starting to gain traction and show results. And second, the company making clear progress towards that FY26 digital sustainability goal. It's a bet on the transformation actually playing out.
Okay, so what's the actual trade structure?
We're thinking long call options, but with a specific expiration, late 2026.
Late 2026. Why that timing?
It allows you to potentially capture two key catalysts hitting around the same time. First, lever one. That's when the full benefit of those $40 million in cost cuts should be flowing through the P&L. Remember, they said about half hits FY26. That should boost margins noticeably.
Right, the baked-in margin improvement from the cost cuts. And lever two.
Lever two is giving the AI suite time to work, about 18 months from now. Enough time, hopefully, to see real evidence, case studies, data showing that it is accelerating digital ad revenue and making that $450 million target look more believable.
So you're buying time, essentially. Betting that over the next 18 months or so, the positive structural changes the cost savings and the AI growth will become undeniable, forcing the market to reevaluate.
Precisely. It's a patient, leveraged bet on the transformation story, eventually winning out over the near-term noise, all while leaning on that Berkshire agreement as downside protection against a sudden collapse.
Okay, let's wrap this deep dive up. It's clear Lee Enterprises had a mixed quarter, to say the least. Headline numbers, the EPS and revenue, they were rough, leading to that stock drop.
But beneath the surface, you see signs of that structural shift accelerating. They hit 55% digital revenue. Subscription revenue per user was way up, 16% growth overall there. And they cut costs significantly, down 7%, with more savings expected.
And they've pinned their future growth hopes squarely on this new AI product suite, laying out that path to digital sustainability by FY26.
Which really brings up a critical question for anyone looking at a company like this deep in a turnaround. How long do you focus on the hangover from a maybe one-time event like that cyber attack affecting subscriber numbers this quarter?
Versus focusing on the managed decline of the old business and the hopefully steady growth of the new digital side? Is the market maybe being too impatient here?
It's a tough balance. So for you, the listener, trying to gauge if this turnaround is real, the metric I'd really zero in on next quarter is that sequential digital subscriber number did bounce back.
If that number starts growing again, it kind of validates management's story that the cyber impact is fading.
Exactly. And that could be the catalyst that shifts the market narrative away from just the misses and the volatility and back towards that bigger picture, that $450 million digital target, which really needs subscriber growth to be credible.
Lots to watch there. Thanks for breaking that down.
Always interesting digging into these transformations. Thanks for joining us.
We appreciate your time and your lead.